All right, well, hello, economics students. Today we're going to be discussing the first topic in our macroeconomics unit, and this is called the gross domestic product. You can get all of this information from your textbook in chapter 13. So watching this and getting the information from here will basically do the same thing as reading through the textbook. It just depends on what your preferred style of delivery is. So when we talk about gross domestic product, or GDP, and you'll hear this term used a lot if you listen to the news or anything about the economy, gross merely means total, domestic means within the country, and product means final goods and services, not intermediate goods and services, but final goods and services. And so the GDP then is the market value of all goods and services produced in the country in 1 year. And it is final goods purchased for final use. So it will take a little bit of practice, and we'll have some practice on this later on. So how do we calculate the GDP? This picture is a little bit fuzzy, but this is generally the equation that we use. C, household consumption. I, business investment. G, government purchases. And NX, net exports. Now, sometimes we will be adding a negative number, which will actually decrease our GDP, depending on what the balance of exports and imports is. Again, we'll look at more examples of this later on. So again, the gross domestic product is the market value of all final goods and services produced within a country during a given period of time. It measures productivity and the size of a nation's economy. It's used to compare strength and size of economies. So if you look at this chart here, we can see that the United States, and this is from 2019, by quite a large margin, has the largest economy in the world, followed by China, and then followed by Japan, Germany, and India. Now, if we divide that out by population, it will look somewhat different. And in fact, the United States economy will look even larger compared to China because of China's large population. So another term within GDP is something called real or versus nominal GDP. So nominal GDP is our current GDP expressed in the current dollar amount. So whatever that C plus I plus G plus NX is in the actual dollar amount that we would pay today on this date right now would be our nominal GDP. Real GDP is an attempt to measure GDP in constant dollars. So this takes into consideration the value of a dollar. For example, how long it takes you to earn a pair of shoes now compared to in 2005 when this particular graph was made. And this way, you can make actual even comparisons between years. And like I said, it removes the distortions of inflation. So taking a look at this particular graph, you see that the gross domestic product has steadily risen. But what we see here is we're starting with a base year of 2005, and you see that the real gross domestic product has not grown as much as the gross domestic product because of the effect of inflation. Real GDP per capita is another important measurement. This is when we take the dollar amount of a real GDP and we divide it by the population. This is an internationally accepted measure of a standard of living. So in the text, we have an example of the United States versus Norway in 2012. The GDP of the United States was 15.7 trillion, and Norway was 0.28 trillion. But when we divide that out by population, the per capita GDP was $49,800 versus $55,300 in Norway. Now, so what is the point of the value of the GDP? Well, basically, it's a good overall measure of economic health, and it does allow us to compare to other times in our history and to other countries. ultimately, we know that things like happiness and joy are things that can't really be measured by a number. But we do generally accept that GDP helps us to understand, at least if an individual within a particular country is able to provide economically for basic needs of healthcare, food, fresh water, etc. So there are some other measures that we can use that look at quality of life standards, infant mortality, life expectancy, and things like that. But the GDP per capita gives us a starting point because we generally know if the GDP per capita is higher, you're generally, not always, but generally going to have a higher standard of living that will lead to an increased life expectancy, a lower infant mortality rate, a lower or a greater likelihood that someone will have food and fresh water. So the GDP is an important measurement for those reasons. What are some limitations of the GDP? It does not include intermediate products. What's an intermediate product? Well, if you are making a candle, you need wax, okay? A wax is an intermediate product, so it doesn't count that. It doesn't count if I sell my car, my old car, to somebody else. It doesn't account for that. It doesn't account for unpaid work. So many people do housework and spend a great deal of time doing housework at home or caring for loved ones, for elderly or for children. And if they're not paid for that work, that's not getting counted. If you're volunteering at places like Feed My Starving Children or Sharing and Caring Hands, it's not going to count that. These are some things that you cannot count within the gross domestic product. And we even have an informal economy. Let's face it, there's an underground economy going on, whether it's illicit drugs or whether it's housekeeping services for cash only, which is quite common in some parts of the country. The occasional day laborer, again, who just gets given money, cash, and they don't really account. Okay, so the other thing that is a limitation of the gross domestic product is that it counts negatives as positives. In other words, if there is a hurricane, for example, and the hurricane results in a large building project to rebuild property that is destroyed, that's actually a negative externality, but that's going to add to the GDP. So that negative externality is not going to be reflected in the GDP. Overexploitation of resources in the production of final goods is also not something that is calculated, even though it's a negative externality. And they don't tell us anything about quality of life. So they don't tell us about the value of leisure time. They don't tell us about how income is distributed. So in some countries, there is a very, very large wealth gap with a percentage at the top end, a small percentage, and a large percentage at the bottom end of the income distribution. And so some of those quality of life indicators that I talked about, like life expectancy and infant mortality rate, might be widely disparate depending on the income. Okay, so this question, what term is defined as the total value of dollar value of all final goods and services produced within a country's borders in a given year after the effect of inflation is removed? See if you can answer that. Which term is a measure of economic output per person calculated as real GDP divided by the total population? So see if you can answer those questions. Which of the following are not included in GDP? It says mark all that apply, but that is an assignment we'll have for a later date. All right, thank you.